The pros and cons of establishing a U.S. sovereign wealth fund. On Monday, President Trump enacted an executive order to establish a new sovereign wealth fund for the United States. The president suggested that this fund might be used to acquire companies such as TikTok. Howard Lutnick, the nominee for Commerce Secretary, mentioned that a sovereign wealth fund could have been utilized to purchase warrants and equity in companies involved in recent medical experiments. Meanwhile, Senator Cynthia Lummis hinted through a tweet, using the Bitcoin symbol, that the fund could potentially be used to purchase Bitcoin. Potential benefits of a U.S. sovereign wealth fund. Despite some skepticism, there are potential benefits to a well-managed sovereign wealth fund. Currently, the U.S. government has limited assets, apart from its gold reserves. A diversified and efficiently run fund could potentially offset national debt losses and reduce reliance on taxes and borrowing. Treasury Secretary Scott Bessent has indicated a strategy to monetize U.S. assets for the American public, possibly hinting at leveraging the country's significant gold reserves, which exceed those of any other nation. Speculation also suggests that the fund might invest in assets like Bitcoin, potentially benefiting current asset holders if the fund drives up market prices. However, the U.S. is not in the usual position of countries that establish such funds, as it currently runs a significant budget deficit. Establishing a surplus to fund the sovereign wealth fund presents a significant challenge. Risks and drawbacks. However, there are significant potential drawbacks to the United States, or any government, initiating a sovereign wealth fund. Howard Lutnick's comment about owning stakes in medical companies that the government has made profitable highlights a potential financial conflict of interest. In recent years, we've learned that it is crucial for politicians and governments to minimize their financial stakes in decision-making processes rather than increase them. Sovereign wealth funds can create an environment ripe for fraud and corruption, as illustrated by the notorious Malaysian sovereign wealth fund scandal, detailed in the book $1 Billion Whale. The susceptibility of sovereign wealth funds to corruption can be attributed to the lack of proper incentives and accountability. Unlike individual investors, the people managing these funds do not bear personal liability for poor investment decisions. Moreover, the vast amounts of wealth managed by these funds, without the need for performance metrics or competition, can lead to unchecked and potentially irresponsible financial decisions. Economic and currency risks. A specific risk for the United States in establishing a sovereign wealth fund lies in its control of the global reserve currency, the dollar, which could edge the country closer to hyperinflation. Historical instances, such as John Law's Mississippi bubble in France, demonstrate the dangers of governments printing money to purchase assets, leading to currency devaluation and economic instability. Challenges in implementation. Further challenges include ensuring fiscal responsibility to prevent currency collapse and navigating the legal complexities of establishing the fund without congressional approval. Additionally, maintaining and growing the fund while safeguarding it from misuse by opportunistic bureaucrats is crucial. It is important to note that any government expenditure must be sourced from taxation, borrowing, or inflation, ultimately impacting the purchasing power of citizens. In conclusion, while a sovereign wealth fund could potentially yield benefits for future generations, it is essential to weigh the risks and ensure responsible management. For more insights on investing strategies that can protect and grow your portfolio in times of crisis, make sure you subscribe.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.